And for the trades heading into those prints, let's bring in Tim Seymour, the Chief Investment Officer of Seymour Asset Management. He's also a CNBC contributor. Tim, we're going to start with shares of Qualcomm reporting. Shares are up 2% ahead of that earnings report and up more than 4% over the past month. The chipmaker recently announced it would be breaking into the AI data center market. So what's the trade for Qualcomm heading into that print?
Well, the core business is better than expected, especially because of their share in the Apple iPhone 17, which seemingly is a better story as well. Is closer to 90% versus the 70% expected. The flip side of that is they have less of a share in Samsung. Both of these, whether it's Galaxy or iPhone, they're looking to be in-house. Right now, Qualcomm seemingly is in a better net position. The AI data center and what it means for AI 200, AI 250 chips for Qualcomm, I think is really the big question. And that's where you get a boost to the multiple at 16, 17 times, not expensive. More important also will be the development of their Internet of Things, their auto business. And I think that's really the core part of the exciting story. AI data center is the buzz here. This chart has backfilled a little bit even of that big announcement, but I like Qualcomm here. I think it's a combination value and has growth drivers.
All right, so that's Qualcomm. Next up are shares of Robinhood. That was the mystery chart, by the way, that we showed you right before the commercial break. Those shares are down about 4% this week, mirroring Bitcoin's move lower, maybe not shockingly. But Robinhood's been seeing momentum in its prediction market business as online betting continues to grow. What's the thesis heading into the print for Robinhood?
Well, the thesis is that it's a financial it's a digital proxy play for all that is going on, whether it's tokenization that they will be, I'm sure, right in the middle of, but other dynamics, and where they are creating with a slightly different demo than the traditional wealth management world, the financial super app. Not cheap, 45 times, but 27 million funded accounts, which is a number that keeps growing, and their exposure for investors who tend to look past the valuation because it is such a proxy to what's going on in the digital space. They have multiple products, just announced a new mortgage business. I think they will continue to grow the top line.
All right, 67 times forward earnings, by the way, for that Robinhood stock. Now to shares of Snap, the parent company of Snapchat. Those shares are off 31% so far this year. Analysts are saying they're keeping an eye on engagement and product velocity as we head into the print. Not too much love on the street, though, for this name. 72% of analysts polled by FactSet have a hold equivalent or neutral rating. But, Tim, you are long Snap.
Yeah, I'm long and like to believe this was bottom fishing a couple years ago, although it's made new bottoms. And I structurally, I'm not sure Snap sits in the right place in the marketing funnel, so to speak, the engagement funnel. But the question is really, what are the drivers here? When Evan Spiegel gave his annual letter a couple months ago, he focused more on cost-cutting savings. That's not a reason to be excited here. This stock, the implied move into these numbers is probably 15 to 16% over the last 8 quarters. It's been a widowmaker. I think expectations are flat, and I think, therefore, the sentiment around the stock, not great, could move higher. Don't get too excited by opportunities here.
All right, not for the faint of heart for sure there. Finally, let's get over to Lyft. Those shares are higher ahead of their results. Uber reported solid third-quarter numbers yesterday, but that still hasn't been enough for Wall Street. Those shares ended the day down about 5%. So, Tim, do you think Lyft could suffer a similar fate or buck the trend that Uber has set?
I think Lyft's at least a relative improved story over Uber, again, relative to itself. Mobility pricing trends are better. I think there's some real excitement around potential Waymo partnerships, loyalty partnerships. I think management changes over the last couple of years have brought a lot more confidence. I'm long the name. I've been long a couple of years. And again, this is a story about normalizing trends in their core business, but where they might be in some of these exciting places, including Waymo. So I like the Lyft story. I think the sentiment here is somewhat mixed. It's had a pretty good move, but I think, at 16, 17 times, this is a $27 stock times 26 EBITDA.